Hey everyone, welcome to this explainer. Today, we're diving deep into something that's honestly a real game changer. We're demystifying a concept that is so fundamental, yet kind of widely misunderstood: how ordinary people actually build lasting wealth over a lifetime. You really don't need a fancy Wall Street background for this stuff. You just need the blueprint we're going to lay out for you right now. So let me just ask you this right up front. What makes investors wealthy without having these massive, extraordinary incomes? Because there's this really common misconception out there, right? That you absolutely need a huge six-figure salary or a crazy inheritance or to basically win the lottery to build a substantial net worth. But looking at the data, the math tells a completely different story. So if it's not a giant paycheck, what exactly is the secret engine driving this financial success? Section 1. The ultimate wealth builder. Section 2. How compound interest actually works. Okay, let's dive into this. At its core, compound interest is basically just allowing your money to earn returns. And then, here's the kicker, allowing those returns to earn returns as well. I mean, think about that for a second. Instead of your wealth just plodding along in this flat, predictable straight line, it actually begins to curve upwards. It starts growing faster and faster as time goes on. It's totally like a snowball effect. Just picture a snowball rolling down a hill, gathering more snow, getting bigger and bigger at an accelerating rate. That's your money. Your initial investment gathers interest, and then that larger pile of cash gathers even more interest. It's pretty amazing. Section 3. The math behind the magic. Now, what's really interesting about this is that the equation is actually elegantly simple. FV equals PV times 1 plus R, all to the power of N. Okay, let's break that down. FV is your future value, right? That's the ultimate wealth you're trying to build. PV is your present value, basically the money you're starting out with today. The R is your interest rate. And that little n up in the corner, that's the number of periods, or simply time. Honestly, this is literally the blueprint for wealth, all written out in a single line of math. Let's plug some real numbers into this to actually see it in action. Let's walk through these specific variables to ground this whole theory in reality. Step 1, you start with a present value of $1,000. Step 2, we apply an interest rate of 5%. That's our R. And step 3, we just let it grow for 20 years. That 20 is our N. So you gotta wonder, what actually happens when we leave that single $1,000 investment alone in an account just compounding at 5% for 2 full decades? It turns into $2,653.30. And remember, you didn't add a single extra dime out of your own pocket to that original $1,000, not 1 cent. Now, sure, at first, like in year 1 or 2, the growth might have seemed kind of tiny. You were just earning a few bucks here and there. But as the years passed, that compounding snowball effect completely took over. It essentially created these massive, dramatic results purely through the passage of time. Section 4. The power of time. And this brilliantly illustrates exactly why time matters so much. On one side, we have our early starter. They're investing a modest, maybe even small amount, but they're doing it consistently over several decades. On the flip side, we have the late starter. They wait years to begin investing. And then, to try and make up for all that lost time, they actually end up having to invest way more money out of their own pocket. But here is the crazy, counterintuitive reality. The early starter will very often accumulate far more wealth than the late starter. Let me say that again. Starting early with less consistently beats starting late with more. Time is literally the secret ingredient that gives compound interest its true power. Section 5. The winning investor mindset. You see, successful investors focus relentlessly on 3 key traits: patience, consistency, and long-term growth. Because let's be real, wealth is rarely built overnight. Successful investors, they don't panic. They aren't spending their days frantically buying and selling, trying to chase down some quick overnight profit. Instead, they focus relentlessly on these 3 pillars. They're patient enough to let the years pass, they're consistent enough to just keep funding their investments, and they keep their eyes fixed firmly on the long game. They take a step back, take a breath, and simply allow their investments to compound year after year. So the crucial point we really want to hammer home today is perfectly summarized by this quote: time is your greatest financial asset. The actual magic happening here is that compound interest fundamentally transforms time, which is something every single one of us has right now, into an incredibly powerful financial tool. The earlier you start and the longer you stay invested, the harder your money is going to work for you. Honestly, this simple truth has helped create countless millionaires, and it remains absolutely one of the most vital concepts in all of personal finance. Which leaves us with this final, incredibly important question: what are you waiting for? Seriously, the math heavily favors those who start today. Every single passing year is basically a missed opportunity for your snowball to grow.
They say the best day to put your money to work was yesterday, but the second best day, that's today. Thanks so much for joining us for this explainer, and we'll catch you next time.